So today I will do a sharing on big tech. Specifically, there are 5 companies that I will be covering. These are the 5 companies that I will cover. You can see that these 5 are the Magnificent 7, right? So out of the Magnificent 7, the 2 companies that I'm not covering is Nvidia because the earnings is in few weeks' times. And then the other one is Meta Platforms or Facebook because I divested already, so I don't have positions. Okay, the first chart, right? This is showing the revenue growth. So you can see here, right? In terms of revenue growth, 3 hyperscalers, Microsoft, Google, Amazon, they are all growing at about 10 to 12%. Apple is growing at about 4%, and Tesla is only growing at 2%. We can see that Tesla is still struggling from, the price cut, right? Because in, let's say, around 2021, Tesla growth was super high. That was when they are ramping up, other automakers facing problems. But in the recent few quarters, we have seen that the revenue growth is kind of like slowed down already. In fact, even all the manufacturing, right, their gigafactory, right, I think they have slowed down already. But a lot of focus is on their AI and full self-driving. We will get into some details later. But the other 3 companies, right, the hyperscalers, right, you can see that they are all, these are the companies that buying a lot of NVIDIA chips, ramping up their AI infrastructure. So I think they benefit a lot from all this cloud business. That's why you can see that their business is growing at about 10%. But you don't see something like 20 to 30% growth is because only the cloud business part is growing at a high percentage. But all these 3 companies, they still have other segments, right? Say, for example, let's say like Microsoft, they still have their Windows, their productivity software, and so on. So the other market is more mature. That's why they are growing at lower growth rate. So when you put together with the cloud business, I think they average out about 12%-ish. So for Google, again, they have their search advertising, which is more like a matured segment. And then for Amazon, it is the e-commerce, also the matured segments. For Apple, really, they don't invest much into all this cloud AI stuff, right? So you can see that their services is mainly still based on iPhones, Mac, iPad, and also their services. Services is still growing quite nicely. It's just that all the other main big category, especially iPhones, right, they haven't been growing at, let's say, like above double digits, right? So you can see that their growth rate is kind of like slowed down already. And then the next chart, I'm comparing their PE. So specifically, this is looking at next 12 months PE, or what they call the forward PE. Forward PE means that consensus, right? Analysts thinks that how much earning that they're going to earn over the next 12 months, and then you take the price divided by these earnings. You can see that Tesla is really, the outlier here because the forward PE is currently at 124 times. The rest are quite reasonable. For example, like Amazon, Apple, and Microsoft, their forward PE is between 30 to 36. The one that looks cheap here is really Google, which is the forward PE of about 21. So I think for Tesla, it's quite clear that the investor, they are not investing in these companies because the earning is super strong. In fact, the earnings is kind of weak. If you look at their fundamentals, numbers, financial statements, it's not that strong. But the part that the investor are betting on is really the full self-driving, how much they can roll out in terms of the unsupervised, autonomous cars. So there are more clarity on where this is heading. But in terms of the financial statements, if you just look at historical numbers, right, up to Q4, the earnings is not fantastic for Tesla. But the rest, I would say, let's say like Microsoft, Apple, and Amazon, about 30 times PE, I think it looks slightly pricey, but it's still within the reasonable range. So this chart, right, I saw this chart from Adam Khoo. He posted this on his X. I think people just want to, draw some comparison, right? When you compare all these big tech, you look at their earnings growth, and then you look at their PE ratio, you just do a scatter plot, you can see that usually those that is having high PE because their earnings growth is high, right? And vice versa. But here it's just quite clear that Tesla is really outlier here because their PE is super high, but their earnings growth is actually in negative territory. So it is quite of outlier here. So the rest will be, I would say, quite reasonable. For example, like Nvidia, growth rate is high. That's why PE also looks on the high side. Also, it all depends on whether you look at PE or forward PE, because if you look at forward PE, because the expected next 12 months earnings is a lot stronger, right? So the forward PE will be a lot lower for Nvidia as compared to what you are seeing here. But this is just a picture to show that sometimes there are correlations between the earning growth and the PE, because investors are always willing to pay a higher PE if they foresee that the earning growth will be high. That is the usual case. But often there will be outliers, say for example like Tesla here, because investors are betting on something else and not something that is already on their financial statements. So this is just some commentary on that. Next I will go through the slides in more details for each of the companies. All these charts, right, when you look at the projection or the trajectory, right, you can have a better understanding, like in terms of where they are heading. Because all these things, right, it's not like every quarter there will be surprise, right? Quite often we see that for every quarter, it's just a continuation of the previous quarter. So let's say for Tesla, right, you can see that the revenue, what I'm plotting here is the last 12 months because it smooth out the quarter to quarter fluctuation. Since around mid 2023, right, the last 12 months revenue is already plateaued and now it's stuck at about close to 100 billions. We don't know when this will revive their growth rate, but I foresee that, let's say, as long as their full self-driving, their autonomous driving is having a good traction in terms of the advancement, right, it's getting better and better, for sure there will be a reasons for new buyers to buy Tesla cars. So a lot of all this progress, right, really is tied with their AI or FSD progress. But if you just look at the recent few quarters, right, really the revenues is already plateauing. In terms of the free cash flow, you can see that around mid 2022, they are having a good year, right? Good time. Just because other automakers are struggling, they are doing well. Since they do all the price cut, right, their margins has came down. Their free cash flow also came down. Right now, let's say on a last 12-month basis, their free cash flow is only at 3.6 billion. I think this is already quite good, given that with all the price cut, right, they haven't really, make the free cash flow drop to a negative level. It's still positive level, meaning that whatever price cut that they introduce, right, they can actually continue with discount pricing for foreseeable future. It is sustainable. Maybe it will make other automakers less sustainable if they want to compete with Tesla in terms of price. This is because at least on the EV space, right, Tesla's scale is a lot larger as compared to other EV automakers. So it's a bit difficult for others. Only the big ones, say for example like Tesla, BYD, they are fine because they have the scale. But for the smaller EVs, right, I think it is quite challenging just because of all this price war that's ongoing now. So free cash flow 3.6 billion. This one just to set a context, right, 3.6 billions. Later we'll look at other companies and you can see that the other big tech, right, their free cash flow is really, off the chart. It's really much higher as compared to Tesla. That's why when we talk about Tesla, you can see that for those who look at fundamentals data, right, they look at financial statements, right, it's hard for them to or to convince them to buy into Tesla because they look at the valuations or the market cap is a lot larger as compared to their free cash flow, which is only, like 3.6 billion. It's really quite a big difference. So in terms of the quarterly earnings transcript, right, I think there are two parts, right. The first part is that I think Elon's keep on pumping the stocks like crazy. So that was my first impressions. He's saying that, this company is not just like worth more than Apple plus Saudi Aramco. Now he's seeing that Tesla will be worth more than, next 4 or 5 companies combined. So he's really bullish on Tesla and he's really pumping the stock very hard now.
And I've said this before and I'll stand by it. I see a path. I'm not saying it's an easy path, but I see a path to Tesla being the most valuable company in the world by far. Not even close. Like maybe several times more than... there is a path where Tesla is worth more than the next top 5 companies combined. There's a path to that.
The other one is that I think it's on the FSD because now they are not just talking about the supervised FSD, right? Which is, we can talk about the version 13 or 13 point whatever that's coming out, right? By the way, if you want to see all this progress, right, you really need to go to YouTube and look at people test driving the new FSD, right? Then you can have an idea on how good it is. But come back to the, what is coming over the next 12 months, right, is that they will start to roll out so-called unsupervised FSD. So this unsupervised FSD means that you don't need a driver sitting in the car can just drive itself. In fact, this already been slowly rolling out. Say for example, right, I think now, let's say after Tesla built the cars, right, when they need to ship the car from a place to the other place, I think as long as they don't have to go onto like public roads, right, they can already drive itself and just, don't need a drivers. So that one is just like, it showcased like their capability now. The other thing is that, let's say if you are in US, right, you can use the smart summon and you just, press on the key and then, or on the app, right? So the car will just drive itself from the parking lot to you. So this is, it's already working. You can check out YouTube and see how it works. I have friends that tested this in US, so they feel like amazed by this. And this is really still not common because not everyone driving Tesla. I would say still there are many people who first time saw these kind of things, they're still, shocked by it. Wow, so suddenly the car just, without a person sitting inside the car, then just drive itself to you and then you just walk into the driver's seats, right? So I think right now people still haven't appreciated fully on the the capability and in terms of what's going to roll out in next 12 to 36 months, right? If you believe this whole thing will translate to huge revenue and huge earnings and good margin, right? That will justify the current valuations. If you can't see past that, right? You don't believe all this thing will work, you think this is going to take longer than the market is expecting, then I think Tesla is just not for you, right? The main one is really this FSD in terms of what they are going to do. From June this year, right, they will start to roll out the unsupervised FSD in Austin. So it will be Tesla own fleet that they are going to test out the app, everything. They just want to make sure things are okay. And then slowly they will roll out to other cities in US, and probably next year they will expand to more places. That is what they are doing now. And once this is done, right, it will become like an Airbnb. So basically, let's say if you have a Tesla car and then you can just contribute your car to the fleet, and then it will drive people around, and then you can take some profit sharings from there. So that is the plan. Okay, whether how good it is in terms of their FSD, you can track this chart which is provided in their deck. So they're saying that right now is in terms of their safety, right? Tesla car, this is with people sitting inside it. So this is supervised FSD. Currently, it is 6 million miles driven before an accident occurs. So this one, you look at the red line here, it will slowly improve, and I hope that it will improve faster because all these technology things, I mean, in terms of the progression, is not linear, right? So hopefully, right now we are looking at 6 million. Soon it will be 60 million, and then 300 million, and so on and so forth, right? It will continue to progress. But the things that is important is that as long as Tesla FSD is able to make people drive safer than without FSD, I think this one people should really adopt all this new technology. This is coming soon, and the progress is continuous, right? All right, let's move on to Microsoft. So Microsoft revenue 261 billion. That's their last 12 months revenue. So you can look at the chart, right? Again, every time I show this chart, right, I just want people not to pay too much attention to just the number, but also the growth or the smoothness of the growth, right? So it just go up slowly. So if you own these companies, you can just close eyes and then just, knowing that after 3 years, after 5 years, the revenue will be higher. So it's not like, those companies that is having high volatility in terms of their revenue numbers, right? So it's very smooth. The other one is free cash flow. Right now, the free cash flow, right? Free cash flow means that the operating cash minus out their Capex is at $70 billion. So 70 billions, right? Just to give you some context, right? If they take these 70 billions and go and buy a company, right? I think they can go and buy, let's say, companies like OCBC, right? Probably OCBC, in terms of their market cap, is about 50 billion-ish US dollar. So if they use it to buy OCBC, they still have 20 billion left, right? So just to tell you, like, just the free cash flow alone is super, super big. And all this is because their business is really, churn out a lot of cash. So as simple as that, right? In terms of their transcript, I think there are a lot of questions regarding like why they are growing slowly and what happened with the cloud. Is it because this is like a short-term thing, or is it because more structural things? I think what they are trying to say is that yes, just focusing on one quarter, sometimes there are some fluctuation, but there's nothing worrying in terms of the longer outlook. So that's one thing. The other thing is that I think all these analysts, right, because all these earnings, they are quite close after the DeepSeek event, right? So they are all asking the CEO, what do you feel about all these DeepSeek situations? Especially for Microsoft, they have a deep partnership with OpenAI, right? So definitely they will ask. So to keep things short regarding this DeepSeek is that I think all these CEOs, right, they are telling people that don't worry about the DeepSeek, because what DeepSeek brought to the table is really all sorts of innovations, and all these innovations will really be copied by all the AI companies, and then they will make all this computing or AI or LLM a lot more efficient. And when these things become a lot more efficient, means that costs will come down, more people can use the compute for inference, and then more companies can use it for AI training. So eventually it will be a lot more efficient, meaning that it will be a lot more cheaper for everyone. So all this will really drive adoptions. So nothing to worry over the medium to long term. So I think that's quite positive, because all these companies, they're not just saying, oh, Jevons paradox and that's it, right? They're really telling you based on their experience, all this AI stuff, even though AI is new, but in terms of all this technology trend, right? The consistent things is that things will get efficient over time. And all this technology, for example, like storage or compute, the cost will come down over time. And you don't have to worry that, costs come down, then revenue will come down. That is not the case, because all these drive adoptions, and adoptions really drive revenue for all the big tech companies here now. So just a few charts that I think just worth to share. For example, like Microsoft cloud revenue, you can see that the cloud revenue is just going up like a smooth straight line, right? I think partly also because all these companies, right, they are subscription based. So subscription based means that companies, they are just paying every month, and then they just keep paying. This is not like something like a one-off purchase that after you make one purchase, you need to wait 3 years to buy another one, and then that 3 years you can actually adjust. It's not like that, right? It's more like a monthly payment, and you just continue to pay because you still need their services. As an investor, they really like this kind of financial statements. Okay, next Next one, Apple. As I say, another companies, not just Tesla, that is having plateauing revenue. For Apple, I think they plateau around 2021 or 2022. So revenue already stuck at about 400 billions. And in terms of growth, you just need to look at the iPhone and you know how much is their total revenue. I think they are still, like 2% growth. Don't say that they have zero growth at all, but to me, 2% growth is the same as plateauing or fixed revenue. Usually these kind of companies, right, when their growth died down, right, their PE should come down. But I think for Apple case, right, I think this revenue, although it came down, right, but in terms of the mix, right, actually they are more pushed towards like services revenue, and services revenue, their margin is higher. That's one thing. And then the other thing is that I think their growth rate on the services, right, is also quite decent. That's why I think market is pricing in a higher PE just because of the quality of the earnings. Because in the early years, right, whenever Apple's have a, like iPhones is selling well, right, people are always concerned that whether this will continue. In fact, like now we see that iPhone sales really stagnated, but they are really pushing for monetizations in other areas, right? Say for example, like their services and subscriptions. So that's Apple revenue. So if you look at the free cash flow, it's even higher as compared to Microsoft. It's close to 100 billion free cash flow. So this is, crazy numbers. If they can use all these numbers, right, to do acquisitions, right? Say for example, let's say Microsoft also did some acquisitions, right? But Apple, I think they are a lot more disciplined when it comes to their cash use. So they use their cash to do acquisitions, but they acquire themselves, meaning share buyback. So you can see that's why their revenue is kind of stagnant. But if you look at the EPS, I think they are still growing. So that's Apple. Talking about share buyback, right? You look at the chart here, the top part, right? The gray bar, right? That is showing the free cash flow on last 12 months basis. And then the blue is the dividend. And then the orange, right, is the share buyback. Their free cash flow, right? Look at the numbers. And then you basically, like almost all of this free cash flow is used to buy back their own shares and paying out dividends. So they are returning a lot of cash to their shareholders. And that also helped to prop up the share price, right? So imagine, let's say a company becomes stagnant, right? Usually share price will really tank. But if the companies, they keep on buying back their own shares, right? That will actually, shrink the supply of the shares. So that prop up the share price. This is just commentary on DeepSeek. So I think what they are trying to say here is really like, okay, all these innovations will make things more efficient. I think it's very consistent message there. But one thing, right, I will say for what Apple did here, which is different from other hyperscalers, is that their AI applications is more towards like what we call the edge computing, meaning that the AI is done on your devices. It's not like on public cloud. So that's one thing. And then second thing, they have their private cloud. In terms of the architecture, right, it's quite similar to the phone. It's actually happening at the cloud because they can put bigger CPU for it to run at the cloud. But in terms of the privacy, I think it is a lot better. So they have quite a unique way of implementations. But the other thing I want to mention is that for Apple, right, just don't say, oh, they don't have all this public cloud. They didn't buy all these NVIDIA chips, so they are gone case in terms of AI, right? I don't think that's the case. It's just that in terms of implementations, right, their implementation is quite different from the other companies. You cannot just brush them away, given that in terms of the chip design, right, they are still one of the best chip designer. So it just depends on how they're going to implement what is going on. And given that all these DeepSeek innovations, right, meaning that nowadays all these LLM models, right, there are tons of algorithm kind of changes that can make it more efficient. So what it means is that in order to run all these LLM, you don't really need such a powerful compute. As long as your edge devices, say for example your iPhones, right, or your Mac, right, they are also getting a lot better and better. And then as all these LLM become a lot more efficient, you can actually just use your own local devices to run LLM. We can see that already. In fact, if you use Apple Intelligence, right, when you use it to do some AI stuff, right, I think it happens locally on the devices. I mean, that just shows that it is possible. It's just that in terms of the advancement, right, in terms of the capability of all this AI, right, it will be a lot better 2 years, 3 years, 5 years down the road. So I think they will take a share in terms of inference, in terms of running all these smaller large language model. So in terms of applications, I think they will just drive a lot of demands. It's just that not the kind of so-called ChatGPT large models that now you really need the NVIDIA chips, right? Think of it like all these LLM, not just like one single model, right? Think of it as like there's a spectrum of models from the super large one that can do things that is as good as the best programmer in the world, right? So that is like a different kind of model compared to some smaller models that can just, for example, when you use your phone, you just want it to help you correct spelling, help you to correct grammar, help you to rewrite, help you to rephrase things. These kind of things, right? Just a small model will do, right? And all these things will be done locally. And Apple implementation is that they will make all these things possible on local devices, and that's where they are sitting, right? So just different kind of implementations. So that's Apple. Next one, let's cover Amazon. So Amazon revenue is even larger. It's at 637 or or 638 billions of revenues. Again, Amazon's one, in terms of their revenue, also growing nicely. I think this is because in terms of their business, whether it's on e-commerce side or whether it's on AWS side, they are all growing. If you look at their revenue breakdown, right, you can see that, let's say, just go back to 10 years ago, right, mainly it's just e-commerce business that is like very large, right? So you pay attention to the December 2015, right, it's only 77 billions in revenue. That's the e-commerce part. The rest are very small. But over the years, you can see that Amazon's, they are not stopping at just, building on e-commerce, right? They are trying to build other line of business. Say, for example, you can see that the purple color third-party seller business that is ramping up, and then you can see that their AWS also ramping up. Advertising now is getting also larger, also ramping up. So subscription also ramping up. Talking about all this streaming, I think they are not stopping here. I think in future they will be, having new business lines. So that is just Amazon's DNA, right? They are not stopping at one go, one place. They are keeping building on new revenue streams. So that's their culture there. And then in terms of AWS revenue, you can see that they are growing. Like right now, is the recent quarter is $28.8 billion of revenue. So just AWS itself, right, is already quite a large business. But you can see that all this, right, the growth, right, you look at just all this bar chart, right, or a line, right, you just zoom out, it looks like a straight line. But if you just look at specific year, right, some years, say for example, let's say like March 2023, right, 21.4 billions become 21.4 billions. So from quarter to quarter, their growth rate sometimes can slow down to even like 0%. So during this kind of period, people are having concerns with whether they are, stop growing, what's going to happen. Sometimes if you watch companies too closely, right, you'll be distracted by all this micro picture where sometimes growth rate can fluctuate, right? But if you just zoom out, right, you need to ask yourself, right, why is these companies, like in terms of their AWS, right, why is it like growing? There must be a reason why companies growing, right? So the reasons for it to grow such a long period of time is really the long-term kind of trend that is playing out. Say for example, most companies, they don't want to maintain their own premises server. They prefer to just let Amazon to handle the infrastructure for them. So this kind of one, right, it is kind of like long-term thing. It's not just, just one quarter. That's why when I invested into companies like Amazon, right, I look for all these trends, and then I look for companies that benefit from all these trends. So the cloud adoptions, right, is definitely one of the trends that already play out for many years, but they are not stopping. They will continue to play out, right? So that's why you see that now in terms of the recent quarters growth rate, right, more companies, they are putting their infrastructure onto cloud, especially for AI stuff. Really is a mess if you want to just buy NVIDIA chip yourself and do it yourself, right? It's better for you to just use Amazon infrastructure, and then you just rent from Amazon. You continue to focus on building on your apps. Let Amazon manage the infrastructure. So that's Amazon infrastructure business. And then in terms of free cash flow, their free cash flow is definitely not as high as compared to Apple and Microsoft, but I think that is also because when it comes to building the business, right, Amazon is the company that really throw out a lot more of their free cash flow to really on all these Capex. That's why their revenue growth is also higher, right? But if you look at their free cash flow, 33 billions, I think this is also still a very decent numbers, given that they are investing heavily when it comes to all sort of things, including their e-commerce business and also their AWS segment. Every time I look at this chart, right, I'm looking at July 2022 period where they are burning cash like crazy. So this is a company, when they see growth opportunity, right, they really can burn cash until it goes to negative. They don't have problem with that. But now we can see that there's a lot of efficiency that's ongoing. That's why free cash flow has went back up to positive level. But now this upcoming AI wave, right, just shows that they are investing heavily again. So that's why you can see that their free cash flow is coming down a little bit. I don't think it will go down to zero. That's not my expectations, but it'll be huge investment first and then follow up by monetizations later. That's their strategy. If we look at the segments, right, basically there are three segments for Amazon. The first segment is their e-commerce business, which is the e-commerce. E-commerce break down to two parts, right? One is the North America segment, which is the blue bar here, and then the other one is the international segment, which is the purple bar. So international segments, right, there's also like mix of different geography, right? So there will be developed market economies where they are having positive operating income, and then there are other emerging market or the new market that they just entered, which is having negative operating income. So if you just sum up these two, right, that's why you look at the numbers, it's as if like all this international e-commerce market is not making money. That is not the case. That is because some market that's making money, some market they're still burning cash in to compete with the competitors, right? So that's why you see the numbers doesn't look good. But if with that said, right, you see since March 2024, the international e-commerce operating income is already positive, and right now we are seeing like 2 consecutive quarters of 1.3 billion of operating incomes. So it looks good there. But the one that is impressive is really the North America e-commerce. So just from quarter to quarter, quarter, right, 5.7 billion jump up to 9.3 billion. So it's really the e-commerce side that is shining because of all the efficiency, all the regionalizations efforts that is ongoing, all the robotic stuff that is ongoing. I think all these are yielding a lot of results in terms of operating income. Just remember that this is also December quarter that we're talking about. So this is the quarter where they are having a lot of festive seasons, holiday seasons, people are buying stuff. That's why numbers also look a lot better. So it's more like a huge revenue in last quarter or December quarter, multiplied by the improvement in the margins, right? So that's why we see a good number here. The other one, AWS, I think this is quite stable. They consistently have decent AWS earnings. Most recent quarter, 10.6 billion, still very decent numbers. So again, I don't want to repeat this DeepSeek again. You can just pause here and to read these things out if you are interested. What Andy Jassy is trying to say here is that he has seen this before. Things are getting cheaper and then more people are using it. In terms of the aggregate demand, right, it will be going up. So he's not worried at all with all these things. And in fact, it is good for companies like Amazon because as all these machines, including NVIDIA GPUs that they bought, right, as soon as all these things become a lot more capable, just because on the software side, things getting a lot more efficient, it's good for them because all these machines they bought now become more capable and they don't have to spend a lot more, right? I think that's definitely a good thing for the buyers of NVIDIA GPUs. Okay, let's go to Google. 350 billion revenue, going up nicely. I think around late 2022, you can see that it's kind of like plateau, then now going up again. So definitely good picture to see here. In terms of the breakdown, you can see that I think the main business segment is still contributed by their search and then also their YouTube. I think both are blue color. That's why you cannot see the split clearly, but doesn't matter. Just group these two together. That's the bulk of the business. But if you look at the other segments, right, say for example, their cloud business, Google subscription business, orange color, the network revenue, all these are growing nicely, right? So you can see that Google, they have been executing quite good. So specifically free cash flow, again, Google is similar to Microsoft level. Free cash flow is $73 billion. That's why they are the strong big tech, right? So 73 billion, crazy numbers. If you break down to different lines, right, and specifically now zoom into cloud revenue, right? Cloud revenue has been going up nicely. And if you look at their percentage growth, right, it's also higher than Amazon and also Microsoft Azure. The good thing to see here is that now this line, right, is not just like revenue growing up, but margin is negative. You see the margin, right, is really going up from negative 1.7 billion in March 2020. Now it's already grown to $2.1 billion just in one quarter. Revenue continue to grow, operating income continue to grow, and that's why this Google Cloud, right, they will contribute decent percentage to the overall operating incomes. So I would say it's really a decent to see how they scale a business from non-profitable segment become a profitable segments. So all this you zoom out, right, you can see very clearly. If you just look at one micro picture, if I tell you that, their cloud revenue is 12 billion and then they earn 2 billion, it's like, 2 billion divided by 12, is it a nice margin percentage? You will be looking at the wrong thing. But what we see, right, as a long-term investor, what we want to see is the trajectory of the business, the revenue growing up, operating income going up, and soon these 2.1 billions will grow to a much larger numbers. Okay, come back to Google. Sometimes people, when talk about Google AI, right, they might say that, Google AI is not as good as, let's say, like ChatGPT, they are behind. That's why if you look at the PE also, it's like lower than other companies. But I would say that for Google, right, in terms of their strength in AI, they are still very strong. And they are not strong, probably, let's say, on their LLM, right? That one is arguable. It depends on how you assess all these LLM. But I think the part that they are very strong at is really on the infrastructure side. Say, for example, Google internal teams, right, they are using a lot what they call the TPU, right? I think that it's called Trillium, right? That's the name they call themselves.
Since 2013, Google has been pushing the boundaries of AI infrastructure.
Custom developed application-specific integrated circuits.
Tensor processing units continue to redefine the limits of what is possible. Today, we're introducing a new generation of TPUs designed from the ground up to power the next wave of AI innovation with power that fuels generative AI. Trillium TPU. Our 6th generation TPU is changing the game.
They don't call it GPU. I think it's closer to ASIC, but it's really like chip that they design in-house together with partnership with Broadcom, and then they roll it out for their own use. And the good thing is that all this chip, right, is a lot more efficient because it is ASIC, right? I think all this infrastructure, right, is really like it will be a differentiator factors. Say for example, if all this TPU is really cheaper to operate, right, it can be a selling point to attract more customers to build on Google instead of like using Microsoft Azure or Amazon AWS. So I do think that in terms of the infrastructure, they keep investing in this area, and it will be a differentiating strength for them. So that's Google. And then I think just to wrap up, right, just want to quickly look at all the Capex numbers that the companies have been just announced over the past 2 weeks, right? Amazon, they announced about like 100 billions of Capex, Google 75 billions, Microsoft 80 billions, and then Meta 60 to 65 billions. So all these companies are still investing heavily in AI, GPUs, all sorts of things, meaning that they see that this AI things, right, is really a space that they cannot miss out. So they're investing heavily here. So the companies that will benefit from here is definitely like Nvidia, which I haven't talked in details. We'll wait for the quarterly earnings. And then this is just to compare the cloud revenues. I think for Amazon is the largest one for sure. So it is growing at 19%. Microsoft is growing at 21%. It's also a decent growth rate. I think for Google, last quarter was the impressive part, right, where we are seeing 35% growth rate, but now slow down to 30%. I think this is really, there's some fluctuation from quarter to quarters, right? And also it depends on which quarter that you are comparing against. So there will be some fluctuation like this, but the good thing is that since they are having a smaller base, hence the percentage growth rate looks a bit high. But I would say that in terms of the cloud, right, this big three, right, maybe you can include like one or two more, for example, like Oracle, right? These are the big cloud players that will be in the game. For those, the rest, right, let's say if you are outside of these top five, right, probably you will be having a hard time to compete, because all these cloud business, they really require the scale in order to be able to come up with pricing that is attractive. So it's still quite a competitive area. Let's quickly mention about Google. Why is it like 20x PE, like significantly lower compared to other big tech, right? I think when we talk about all this AI, and if you just look forward 5 years to 10 years, right, I think there's concern about their search business, because right now people are still using Google a lot because you just want to do your Google search and then they serve you the links, right? So and by serving you the links, they are having a sway in terms of like how much ads that you are seeing. But imagine that all this AI stuff is getting a lot better, right? There will be more and more people just use AI, use ChatGPT to really do their search. So that will take away the search from Google. But Google is still, that's why they are trying hard to have a space in terms of their large language model, right? But I imagine that let's say 5 to 10 years from now, you will be doing your ChatGPT, and then when you do your search, right, some advertisement will pop up, and that part is the part that will grab some market share from Google. At least that's the part that some investors they are worrying about, because the search and advertising is still a large proportion of Google revenue, right? So that's why they are coming down. Even if let's say like Google AI is as good as ChatGPT, right, but still their highest margin business, which is their ads and search, right, will be affected. They will be cannibalizing themselves. So that's why this concern will be there, right? That's why the 20x PE, I think, is because of this. And then you can see that which company is benefiting from this, right? I think right now, if we talk about advertising, the one that is doing quite well recently is Amazon. You can see that their advertising is growing nicely, right? So they're eating some share. That is the trend. I won't say that this will continue, because sometimes all these things is hard to say, right? But just to show here is that Google revenue in terms of their ads, right, is still much higher as compared to the rest. Is when you talk about online advertising, right, it's only two companies, Google and Meta. These are the only two. And maybe you can add in the Trade Desk TTD into the picture, but their business model is quite different compared to Google and Meta. So I think that's it. That's all the presentations. I think there's one question from one of the member in Telegram group, right? He asked me to comment on the position sizing, meaning that let's say my portfolio, right? How do I allocate the weights into each of these companies? So I'll say my approach, right, is that first thing I will start with equal weight. So for the companies that I have strong conviction on, say for example, you can tell, right, from all the sharing that I did in the past, right? I'm very confident in companies like Apple, Microsoft, all these companies, right? Google, Nvidia, Amazon, all these companies, I'm really like bullish on them over the long term. Okay, I will start with something that is quite close to equal weight, meaning that their percentage allocation should be the same. Okay, that's I call it the starting point, right? And then from that starting point, from time to time, I will weight more towards certain companies for all sorts of reasons. Say, for example, the first one is that, let's say I think that the company is a good one, but suddenly for some reason, the price just came down, right? So if the price came down, I just want to take advantage because I think that the price may went back up, right? So it may go back up in the future, right? So I will just, buy first. So sometimes I will over allocate within short period of time just because of that. So that's one reason. The other reason is that sometimes I do see that there will be development, which I think I just want to capture first before it shows up. Say, for example, let's say if I saw that, Tesla side is really like having a lot of traction in terms of their FSD, I just want to front run it, right? Because I think that some other investor, they haven't seen things that is coming. So I want to take advantage. I might also buy first. So over allocate now and then let it play out later. So this kind of like short-term things, I will still, let's say if there's such opportunity, I will allocate. But usually I won't sell my positions and just play around all these allocations. That's not my style. Because when it comes to purchase, right, I always have the flexibility to buy whichever companies that I want to buy at that period, right? So that's what I'm doing. But if I don't have a view, I will just buy ETF. So that's my approach. Yeah, that's the general philosophy. But of course, if you look at my portfolio, there will be some companies that is having like very tiny allocations. Say for example, let's say I have Snow, which is like having very small allocations. That is just because my conviction on this company is not as high as compared to other companies, right? So I bought that not long after the IPO, and then just a small positions, I just keep it there, just see how it play out. So anyway, it's small positions, right? So even if I clean up that position, I sell that, I don't think it's like a big changes to my portfolio. That's the small positions part. All right, see you in the next one. Bye bye.